Silver has historically served two roles that markets often treat as incompatible: a monetary reference point and a critical industrial input. In periods of economic stability, the industrial narrative dominates. Silver is priced as a raw material, cyclical, replaceable, and subordinate to growth expectations. In periods of monetary stress, however, that framing breaks down. Silver begins to behave less like a commodity and more like a diagnostic instrument, reacting not to demand forecasts, but to distortions in the financial system itself. The present environment shows early signs of such a transition. Across developed economies, the official narrative remains one of stabilization. Inflation is described as contained, growth as resilient, and monetary tightening as effective. Yet beneath these surface indicators, the structure of the global financial system tells a different story. Sovereign debt levels continue to expand at rates incompatible with long-term servicing under normalized interest conditions. Central bank balance sheets, though rhetorically restrained, remain historically elevated. Real interest rates, when adjusted for asset inflation and fiscal expansion, remain marginal at best. Silver is responding to this contradiction. Unlike equities, which are buoyed by liquidity and forward earnings assumptions, or currencies, which are managed through policy signaling, silver is influenced by a narrower set of variables. It reacts to trust in monetary discipline, availability of physical supply, and the credibility of financial settlement mechanisms. When those variables begin to weaken, silver tends to move quietly, often before broader markets register discomfort. This has occurred repeatedly. Prior to major monetary inflection points, silver has demonstrated anomalous behavior, rising or stabilizing when growth assets remain complacent or refusing to fall despite tightening rhetoric. These movements are rarely dramatic at first. They appear as resilience rather than rallies, divergence rather than confirmation. As a result, they are often dismissed as noise. The current signal follows this pattern. Silver prices have shown persistence despite conditions that should, under standard models, suppress them. Strong nominal rates, a firm currency environment, and moderated inflation expectations would typically weigh on precious metals. Yet silver has not responded as expected. Instead, it has maintained upward pressure and reduced downside volatility. This is not speculative enthusiasm. It is structural discomfort being expressed through a market small enough to move early, yet large enough to matter later. The reason silver moves early lies in its position at the intersection of finance and production. It is embedded in industrial supply chains that cannot pause consumption during monetary transitions. At the same time, it exists within a pricing system dominated by financial instruments rather than physical exchange. This makes silver acutely sensitive to mismatches between monetary narratives and operational reality. When confidence in monetary management weakens, capital does not immediately flee to safety. It first becomes selective. Risk is reweighted rather than abandoned. In this phase, silver attracts attention not as a hedge against collapse, but as an asset exposed to systemic pressure points. It reflects stress before fear becomes explicit. This early movement is rarely recognized by institutional capital. Large funds are constrained by liquidity requirements, benchmark considerations, and volatility tolerance. Silver, with its relatively small market size and history of sharp moves, does not fit neatly into early-stage positioning. As a result, it remains underallocated until price confirmation forces engagement. By the time this occurs, the repricing is often well underway. For decision makers, this creates a timing asymmetry. Those who wait for confirmation pay a higher price, financially and strategically, than those who interpret the signal when it is still ambiguous. Importantly, this signal should not be confused with a prediction. Silver is not forecasting a specific event. It is responding to conditions that have historically preceded broader adjustments: excessive leverage, fiscal dominance over monetary policy, and declining tolerance for real economic contraction. These conditions do not resolve cleanly. They are managed, deferred, and obscured until they are not. Silver's behavior suggests that the current management phase is reaching its limits. The metal is not yet in a repricing phase. It has not entered the volatility regime associated with monetary panic or policy failure. Instead, it is exhibiting something more subtle: refusal. Refusal to trade lower under narratives of control. Refusal to align with models that assume normalization without consequence. This refusal is the signal. For the business community and strategic capital allocators, the implication is not urgency in action, but urgency in attention. Signals precede outcomes. Markets that ignore early indicators do not avoid adjustment. They experience it later at higher cost and lower flexibility. Silver is indicating that the margin for error is narrowing, not imminently collapsing, but structurally constrained. In such environments, the most consequential decisions are made before consensus forms, when movement appears premature and caution feels optional. The crowd has not noticed. Historically, that is when the signal matters most. The structure: paper, silver versus physical reality. To understand why silver's signal carries disproportionate weight, It is necessary to examine the structure through which its price is discovered. Unlike most industrial commodities, silver is not primarily priced through physical exchange. Instead, it is priced through a dense network of paper claims, futures contracts, options, unallocated accounts, and derivative instruments that reference silver without requiring its delivery. This structure functions efficiently in periods of confidence. It becomes fragile when that confidence is tested. At the center of this system is leverage. In the paper silver market, claims on silver exceed available physical metal by multiples. This is not an anomaly, it is a design feature. Futures markets were built to provide liquidity and hedging capacity, not to serve as delivery mechanisms for the majority of participants. As long as contracts are settled financially and positions are rolled forward, the system remains stable. Physical constraints are theoretical rather than operational. The risk emerges when assumptions change. If even a modest share of participants begin to demand physical settlement, or if counterparties become less willing to extend credit within the clearing system, the structure tightens rapidly. Unlike fiat currency, silver cannot be created at will. Supply is constrained by mining capacity, refining throughput, and industrial consumption that does not pause in response to financial stress. This creates a structural imbalance, a pricing system that assumes abundance, resting on a physical reality defined by scarcity. Reported inventories often obscure this imbalance. Vault figures, exchange stocks, and warehouse reports suggest adequacy, yet these numbers rarely distinguish between metal that is available for delivery and metal that is already encumbered. Much of what is reported as inventory supports multiple claims simultaneously. This is not fraud, it is standard financial practice. However, it relies entirely on the assumption that claims will not be exercised concurrently. Confidence, therefore, is the real reserve asset. Historically, this confidence has been maintained through a combination of price volatility and institutional credibility. Sharp downward moves discourage physical demand and reinforce the perception that paper exposure is sufficient. Clearing mechanisms, backed by large financial institutions, provide reassurance that contracts will be honored, even if settlement is financial rather than physical. Yet this confidence is not immutable. In periods of broader financial stress, participants reassess counterparty risk. They begin to differentiate between exposure and ownership, between claims and control. In such moments, assets with complex settlement chains are reevaluated. Silver S structure places it at particular risk during these reassessments because of the mismatch between the scale of paper exposure and the depth of physical supply. This does not mean that the system is on the verge of collapse. Structural fragility does not imply imminent failure. It implies sensitivity. Small shifts in behavior can produce outsized effects. For example, industrial users who rely on just-in-time inventories may seek to secure longer-term supply during uncertain conditions. This increases physical demand without increasing speculative activity. At the same time, investors who previously accepted unallocated exposure may seek allocated or deliverable positions. Neither action is dramatic in isolation. Together, they reduce the margin for error within the system. Price, in such environments, becomes less a reflection of marginal trading and more a mechanism of rationing. It rises not because of enthusiasm, but because it must. Higher prices discourage non-essential demand and restore equilibrium between claims and availability. This process is often misunderstood as speculative excess, when it is, in fact, structural adjustment. The paper market resists this adjustment. Its function is to smooth volatility and maintain liquidity. It absorbs stress until it cannot. When the gap between paper confidence and physical reality becomes too wide, repricing occurs rapidly, not gradually. This dynamic explains why silver's price behavior can appear disconnected from macro indicators. Interest rates, currency strength, and growth forecasts matter less than settlement confidence and supply assurance. When those are questioned, traditional models fail. For decision makers, the implication is structural, not tactical. Exposure to silver is not simply a view on inflation or industrial growth. It is exposure to a system whose stability depends on behavior remaining predictable. When predictability erodes, price discovery changes character. The warning embedded in silver's structure is therefore subtle but consequential. Markets can function with leverage. They cannot function without trust. Paper silver assumes trust as a constant. Physical reality treats it as a variable. As long as that distinction is ignored, pricing remains compressed. When it is acknowledged, by even a minority of participants, the adjustment can be swift. Silver's recent resilience suggests that this acknowledgement is beginning, not as panic, but as prudence. Historically, that is how structural repricing starts. The demand shift, who is accumulating and why it matters. While the pricing of silver remains dominated by financial instruments, the underlying demand for the metal is undergoing a quiet but consequential shift. This shift is not driven by speculative enthusiasm or retail momentum. It is driven by actors whose behavior is shaped by necessity rather than narrative. Understanding who is accumulating silver and for what reasons is essential to understanding why price signals are becoming harder to suppress. The most important change is occurring within industrial demand. Silver is no longer a marginal input used primarily in discretionary manufacturing. It has become a critical component in sectors tied to long-term national and corporate strategy. Energy infrastructure, electrification, advanced electronics, and precision manufacturing all rely on silver's unique conductive and chemical properties. These uses are not easily substitutable. In many applications, silver is not chosen for cost efficiency, but for performance reliability. As a result, industrial consumers approach silver differently than financial participants. They do not respond to price movements with speculative behavior. They respond with procurement decisions. When uncertainty rises, whether related to supply chains, geopolitics, or financial stability, industrial users do not wait for price confirmation. They secure material. This behavior introduces a structural rigidity into demand. Unlike investment flows, which can reverse quickly, industrial accumulation tends to persist. Once inventories are built or long-term contracts are secured, the metal is effectively removed from the market. It does not return during price pullbacks. This reduces available float and increases sensitivity to incremental demand elsewhere. At the same time, sovereign and quasi-sovereign actors are reassessing strategic materials. In an environment where financial sanctions, trade restrictions, and supply chain disruptions have become normalized tools of policy, physical resources are being reclassified as strategic assets. While silver does not receive the same public attention as energy commodities or rare earths, it occupies a critical position in the technological stack that underpins modern economies. Quiet accumulation, through state-linked entities or long-term offtake agreements, reflects this reassessment. This accumulation is rarely disclosed in real time. It appears later in retrospect, when inventory data no longer reconciles cleanly with reported production and trade flows. By the time this discrepancy becomes visible, the underlying shift has already occurred. Retail investment, often blamed for volatility, plays a secondary role in this process. While individual investors do contribute to physical demand, their impact is frequently overstated. Retail behavior tends to be reactive, not initiatory. It follows price movement rather than causes it. More importantly, retail demand is episodic. It surges during moments of visible stress and recedes during periods of calm. The current demand shift is different. It is continuous rather than cyclical. What makes this shift particularly significant is silver's supply profile. Unlike many commodities, silver production does not respond quickly to price incentives. A large portion of silver is produced as a byproduct of mining for other metals. This means that higher silver prices do not immediately result in increased output. Supply elasticity is low, especially in the short to medium term. When demand increases under these conditions, the system absorbs the pressure through inventories rather than production. Once inventories decline below functional thresholds, price becomes the only remaining adjustment mechanism. Geographically, demand patterns are also diverging. Western markets continue to treat silver primarily as a financial asset. Exposure is gained through exchange-traded products, derivatives, and managed funds. Physical ownership is often abstracted away. In contrast, other regions prioritize physical control. Accumulation occurs through direct ownership, long-term contracts, and strategic reserves. This divergence creates a structural imbalance. Price is set in markets that favor abstraction, while supply is absorbed by actors who prioritize possession. This imbalance can persist for extended periods. It is sustainable as long as physical flows align with financial expectations. When they diverge, price signals adjust abruptly. The critical point for decision makers is that demand does not need to overwhelm supply to force repricing. It only needs to exceed the system's tolerance for uncertainty. When participants begin to doubt the availability of silver at quoted prices, behavior changes. Orders are placed earlier, inventories are padded, substitution is explored and often rejected. These actions are rational and incremental. Collectively, they are transformative. Silver's demand shift is therefore not visible through headlines or sentiment indicators. It is visible through persistence, sustained drawdowns, reduced responsiveness to negative macro signals, and a growing disconnect between price models and physical flows. Historically, such conditions precede repricing events, not because demand explodes, but because the system's assumptions no longer hold. When silver is treated simultaneously as a strategic input and a financial abstraction, tension builds. That tension does not resolve quietly. It resolves through price. Ever wondered about those crazy price targets for silver? People often treat them like wild guesses, but that's not the whole story. In stable times, prices move slowly, step by step. But when the monetary system gets shaky, the rules change completely. Silver doesn't just drift towards a new price. It's launched there by immense pressure. History shows us a clear pattern. Silver's repricing is sudden, explosive, and often misunderstood until it's already happened. Think of it like a dam holding back water. For a long time, the pressure builds, but the dam holds. Silver's price stays suppressed way longer than you'd think. Then a crack appears. Confidence in the system weakens just a little, and the dam breaks. The price doesn't trickle up, it floods, adjusting violently to catch up with reality. This isn't a smooth trend, it's a sudden discontinuous leap. We've seen this before. Whenever currencies wobble or governments lose control of their finances, silver has consistently blown past expectations. This isn't just a bunch of speculators jumping in. It's because silver has a special role right below gold in the monetary food chain. Big institutions and central banks buy gold first. Silver comes next, but when it moves with incredible speed. Its market is smaller, its price is lower, and it has industrial uses, all of which amplify the price surge once serious money starts flowing in. People often mistake this explosive move for a bubble, but it's not. It's the market playing catch-up. Because the repricing was delayed for so long, the adjustment gets compressed from years into just a few weeks. Silver doesn't just rise to a new fair value, it overshoots, then settles back down. That overshoot isn't irrational. It's the market compensating for being held down for too long. The relationship between gold and silver gives us another huge clue. In calm markets, the gold to silver ratio gets wider. Gold just feels safer. But during a monetary crisis, that ratio collapses. Silver's price rockets up faster than gold's, not because it's suddenly better than gold, but because it's repricing from a state of total neglect. This pattern is held true across every major monetary event in history. So these price targets aren't just random numbers. They represent a new equilibrium based on trust, or the lack of it. They are shaped by real interest rates, the debasement of our currency, and the desperate search for real assets that can act as insurance. What truly matters isn't the specific price number, but how we get there. If it happens suddenly, it's because the system was forced into a corner by a policy mistake or a liquidity crisis. In that scenario, silver doesn't stop at small resistance levels. It just keeps going until enough people have jumped in to stabilize the price. Those who jump in late often call it a bubble, and that's a very expensive mistake to make. A true bubble is built on hype and borrowed money. Silver's repricing is different. It's driven by the recognition of a broken system. The price moves first, and the story explaining why comes later. Ironically, the very policies meant to calm the markets, like printing money or suppressing interest rates, only add more fuel to silver's fire. Every attempt to prop up the financial system just reinforces the case for holding hard assets that exist outside of it. And because silver is both a monetary metal and an industrial commodity, it absorbs this pressure like a sponge. For anyone trying to protect their wealth, this is a strategic insight, not a tactical trading tip. A high silver price target isn't a finish line to cheer for. It's a barometer of systemic stress. The higher the price goes, the bigger the underlying problem was. The real opportunity wasn't when the price was exploding. It was earlier, when everyone else thought such a move was impossible. Remember, silver doesn't move in a vacuum. Its repricing happens alongside a loss of confidence in currencies and stress in the bond market. By the time these problems are making headlines, silver's big move is often already over. This creates a huge risk for those who are unprepared, forcing them to make rushed decisions at terrible prices. But for those who understood the structural reality, they benefit not from a lucky guess, but from being correctly positioned for what was always likely to happen. History tells us these massive distortions don't just fade away. They are resolved through violent repricing, first in the small markets that can move quickly, like silver, and then in the big ones that are too large to ignore. Thanks for watching, and be sure to subscribe for more insights.